And we're joined now by Dr Elna Moolman, the head of macroeconomic fixed income and currency research at Standard Bank. Elna, thank you so much for joining us this afternoon. Let's first go to the reasons given for this unchanged view. We know it was a 2-3 split, so it wasn't, not everybody agreed. What do you think about their reasoning? They were citing geopolitical, climate change, load shedding as well. What for you was the most important reasoning for the unchanged decision?
Good afternoon. I think the focus in this entire cycle has really been on the inflation side. So we could say, on the one hand, they're cognizant of weak growth and they're cognizant of the pressure on consumers, etc. But to my mind, it's really all about the inflation story. And there specifically, inflation has come down significantly from its peak. It peaked at 7.8. Now we're at 4.8. The inflation forecasts are also going towards the midpoint of the target range. And then very importantly, inflation expectations have declined. The SARB would still like them to be a little bit lower, but they have at least declined. And at the current rate, and we have to take into account we've hiked rates quite aggressively. If we look at the policy rate from 3.5 to 8.25, that's a significant increase. And if we look at it relative to inflation, so the real rate, then the real rate is at 3.75%. Whereas the Reserve Bank is saying at roughly 2.5, we're at neutral. So we're actually, constraining the economy a little bit if we have such high real rates. So I think it's really that inflation picture that gives them the comfort to pause now.
Yeah, the governor also today made mention of the restrictive territory we're in. Do you think that the Reserve Bank is still in their restrictive territory? One would think if they were to be in the restrictive territory, they would have hiked rates, but they're still keeping it unchanged.
Yes. So when they refer to restrictive, they typically think of it in real terms, so where the repo rate is relative to inflation. And again, if that's almost 4%, whereas they think 2.5 is more or less neutral, then it means they're quite restrictive. In other words, rates are so high that it is helping to contain inflation, but also putting pressure on economic growth. And so then we have to say, what are the growth inflation dynamics at this stage? So we know growth is weak. We see no evidence of demand pull inflation. In other words, things driven by the strength of the consumer, such as rental inflation, is very low still. And we're not really seeing significant pressure on wages in general. And so if that is the case, then monetary policy doesn't really have to tighten any further. Then it means that they are succeeding. And ultimately, if you're an inflation targeter and your medium-term inflation forecasts are at the midpoint of your target range, again, you've achieved your objective. So you don't need to put even further pressure on consumers and the economy.
Let's take a look now at the outlook. And I think this is something that could change quite dramatically if we look at something like fuel hikes that are expected, which could drive up inflation. The Secretary also mentioned the outlook for load shedding and the impact that has on costs. What is your outlook specifically for inflation and how that is linked to interest rates?
Yeah, so unfortunately, the best news is almost behind us. In other words, we had that 4.7% and then the 4.8% inflation print, and that's as low as it's going to go for now. So when we get the next inflation data, which would be for September, I think that it will be at least 5.5%. So already quite a significant increase and getting closer then to the top of the Reserve Bank's target band, that's 6%. So quite a significant increase, like you say, partly because of about a 10% increase in fuel prices in September. And the problem is that we are now concerned about, further increases potentially in fuel prices. In other words, oil prices are higher than we expected a while ago. And we have the currency weakness. And so our expectation is that we'll be close to the upper end of that target range for the next couple of months, and only kind of towards the middle of next year, really more sustainably come back towards 4.5%. So the next couple of months, unfortunately, are still going to be higher inflation with further upside risk.
Yeah, something closer to the heart. Food inflation also still very high at 8%. It did come down quite a bit from 10% the month earlier. And the government also mentioned climate issues and the El Nino causing weather system causing the drier conditions and the impact that could have on food inflation. He's also saying that there are risks to the upside for something like food inflation, and that's something that's very close to consumers' hearts.
Absolutely, and we share those concerns. Our base case, our forecasts for this stage, it factors in the expected El Nino, but the weather forecast that we're focused on suggests that we should still have, South Africa specifically, should still have reasonable rainfall. Typically, we don't have that. When we have an El Nino, we tend to have a much drier season, but this time around, for a number of weather-related factors, the expectation is that we could still have reasonable rainfall. Now, that can change. These forecasts do change as we get closer to the actual events, but if that plays out, then we should have an ongoing moderation in food prices. If we have a severe El Nino at the end of the year, and if it is reasonably dry, then it would mean that we'll probably in the second half of next year, so quite long delays. The El Nino impact will be at the end of the year, and then it takes about 6 to 9 months before we really see the full impact on our food prices. So then towards the end of next year, we'll see renewed food inflation pressure.
Elna, with something like the oil price, specifically the international oil price, there's not much we can do on a local level. That is due to supply cuts from big OPEC countries. But something like the rand-dollar exchange rate, and he made mention about a 10% depreciation in the rand-dollar exchange rate. Is there something that could be done on a local, on a South African level to mitigate the impact it has on us?
So I think at this stage, of course, part of the reason for the rand's weakness is the unfavorable global conditions, and he also spoke about the weaker commodity prices. But we think that even relative to that, the rand is undervalued. So there's a sizable risk premium built in, even once we adjust for all of those factors. And essentially, that just comes down to investors' concerns about South Africa's weak growth. And that, of course, creates a fiscal problem. And so as long as we have those uncertainties, we'll continue to have that risk premium and an excessively weak rand. So if we could address those, if we can take significant fiscal decisions in the MTBPS and or budget next year to ensure investors that we have our fiscal house in order, that it is a sustainable fiscal path, then I think we can see a significant reduction in the risk premium. In other words, then the rand can be a little bit stronger. And I think we have to acknowledge on the growth and reform side, we've seen significant improvements in electricity, mainly coming from the private sector, taking the opportunity to invest in generation capacity. Now we need to see whether we can also have the same kind of momentum in, for example, the logistical sector. If we do that, then again, I think the risk premium will come down and it will all around be favorable in terms of capital outflows and sentiment and confidence, etc.
Just the last one, Elna. Is there any hope for a decrease in interest rates in 2024?
I believe so, yes. So our forecast at this stage is it will be very gradual and it will be a very shallow cycle. And we'll probably only go back towards, let's say, a 7% repo rate. So from the 8.25% now to 7% at best. So no more than 1.25%, but probably starting somewhere in the first half of next year, unless we get renewed shocks.
Thank you so much for your time, Elna. That was Dr. Elna Moolman, the head of macroeconomic, fixed income and currency research at Standard Bank.